All right, we're starting back. I have a chart here of March 07 cotton, and it's only through December of 06, so this is still trading. And I think Alex said that he bought it right here in this November low. It was an excellent place to go long. And I've annotated this chart, what I'm discussing primarily on this chart is showing the ease of downward movement or the ease of upward movement, and I have symbols for those two words or phrases. And I'm showing how there's no follow-through or lack of follow-through after certain points on the chart where it appeared that it could break down or rally against the trend. First of all, starting with price bar number 1, the November high, and this is a trading range that I have defined here. You see the low. And this was a test of the upper end. There was a high to the left, which is not shown. And we up-thrusted the top of that high. In other words, the market rallied above it, and as so often occurs, we have a downward reversal. And you notice right away that since the market turned up from the October low, that the break on this day is probably the largest of any down day since the market turned up. But more importantly is the failure to hold the gains as it broke out and then reversing and closing near the low. The second day, however, which I have no remark attached to it, the market holds. There's no downward follow-through. And the market holds and recovers, giving it a chance to resurrect the trend. And in an uptrend, or any trend, when you have bad-looking days, there often is this resurrection effect, which I'll talk about more. But as it turned out, you see, I said no upward follow-through. Instead of recovering further from this holding day, the second day, the market turns immediately lower. There's greater ease of movement than there was on the second day, and again we close near the low. On this, the fourth day, we have great ease of movement. We have a very weak close, and we have very heavy volume, the heaviest volume on the chart. And when you see a market pulling back towards the bottom of a trading range and the volume beginning to expand, the odds favor that you will break the bottom of the trading range. It often occurs that when a market comes back to a low and there's a great deal of volume and you haven't penetrated the low yet, to expect such a penetration. The market holds for a day or two and tries to stabilize, but here on day 7 the market does rally intraday, but then has a severe sell-off from high to low. And I made the note that the intraday rally fails to hold, and again we have a weak close. Now what is particularly of interest on this chart, and we'll see it on others and we'll talk about it some here today, when a market goes below a level of support and there's no widening of the price range, one should be alert to the possibility of a turnaround. It may not occur the very next day, because you see even on this chart, the market on this day breaks underneath the low of the support line, but there's no acceleration. It closes in mid-range, but it still closes lower. The volume is relatively low. There's not a great deal of selling pressure. But what catches my eye more than anything else is the fact that there's no ease of downward movement. When there's no ease of downward movement, no acceleration or widening of the price range, when prices fall underneath this level of support, your ears should stand up. Like a little pointer in the field. All of a sudden, you get very stiff and straight, and your tail goes up in the air, and you don't move. You're motionless, because there is something here, and not just a covey of quail. On the second day, the market actually manages to go lower again. And again, there's almost no follow-through, just tiny downward progress. And the market bobs back up to close well off the low, and in this case, it closes even slightly higher. But what catches my eye more than anything else, two things: that the market has not accelerated lower, There's been no serious downward follow-through on the break of this support line, and that the market keeps coming back and closing well off the low. The lack of downward movement tells me there's no real serious selling pressure, or we would have broken with ease. And the fact that the market keeps recovering to close well off the low is a sign that there is more buying down here than one would have expected on such weakness. This is a spot on charts, you'll see it over and over again. And before we go any further with this chart, if we could go over to a recent chart of USO, United States Oil Fund, you see the market goes underneath a level of support. This was the low of the year, the low ever in USO, the stock, because it's relatively new. There's great ease of downward movement. We close on the low. There's very heavy volume. The sellers are in control. But look at the next day. No serious follow-through. Look at that narrow range. Instantly you should be interested. Here is a place to make the bet. We're buying at the danger point. We're right on the edge of the cliff, right? This thing could just fall and fall and fall. So what? I'm going to make the bet here. And the next day, just like on the cotton chart, it actually went a little bit lower and did not follow through and bobs back up to close near the high of that day. Now when a market goes underneath the level of support, it puts it in what's known as a potential spring position. When I see this kind of a situation where a support is broken, preferably with heavy volume, but it doesn't always happen that way. But when a support level is broken and the market goes underneath the level of support and the ranges begin to narrow, I think this has a 75% chance of working. Now, in a bear market, when the trend of stocks is bearish and all stocks are going down, we might have to change that percentage. The trade that's created here, of course, was only a rally and a downtrend, but it was a trading opportunity. And it was a nice trading opportunity. And you notice that the market jumped up here and then had one more test, one more gut check to see if you could hold on. In any event, you see how the market did have one more test. I want to show you another one because it's such a beauty. It's one of my favorites. This is APA, Apache. We have a trading range that I've defined. I'm always drawing the resistance line and the support line. Everything on this chart looked bearish. Right here at point number 1, there is great ease of downward movement, just as there was up here. The market is now in trouble. The market has come out of an apex that you can see right here and right here. It's been coiling. And finally, it's broken down out of that apex with widening price spread and very heavy volume. It looks terrible. It is ready to fall apart. At point number 1, at day number 1, I would certainly say that. Look what happens in the next day. Can anyone tell me what is different about the second day? Any observation, just a logical observation about day number 2?
Range is smaller.
Range is smaller. And yet, the volume is greater. All of the volume that we had on day 1 is exceeded on day 2, and day 2 has half the range as day 1. Does that register in your mind that there might be something going on there? There's a message there. The message is there's lots of selling here, but we're not getting any great ease of downward movement. If we're not getting any great ease of downward movement in the face of all that selling, ergo, somebody is buying. Right? Does that make sense? Yeah. Day 3 in our little discussion. What happens when the market goes underneath the level of support? There's no widening price spread. A narrow range day. Look at the volume on day 3 compared to day 1. It's bigger. This is what's known as bag holding. Some very large interests are holding the bag open and letting the whole world sell into it. Come on, chickie. And it's receiving all kinds of bad news, obviously. I mean, obviously day one must have been mentioned on CNBC, right? APA was hit terribly today. In any event, on day three, a narrow range day with more volume than on day one in a much smaller range. So the inference is already, the evidence is building that this market wants to turn up. The fourth day, we rally with the greatest amount of volume of any of these 4 days. We rally above the highs of the previous 2 days, of day 2 and day 3. And we close closer to the high than the low. There's good ease of upward movement on this day. This day is wider than day 2 or day 3. Demand is coming into this market. On the next day, we get the proverbial gut check one more time to see how many people are still willing to buy the market. It's driven down again, and we hold the lows, and we recover to close well off the low, and now the selling pressure is much less. So the market is ready to go. But what happens? You know, we all want that cigar. We want this thing to take off and close strong, that instant gratification. And the world doesn't work that way, unfortunately. It would have been textbook, right? For the market to rally the next day and close on the high. And this stock is going to rally. It's going to go to 70 some odd dollars. And relatively quick, in a month or a month and a half. But I stopped here on purpose because I wanted it to look bad. I wanted you to see it at its worst right before it took off. And I mean, it looks great. It's just that one day doesn't make the whole picture perfect. Because the charts are not always perfect. That's the message. Any questions about this chart? Yes?
In this series of days you've shown us, David?
Yeah.
At what point would you be a buyer?
I would say after day 3, I'd close my eyes and go long. Okay. Put the stop and walk away. This is one you don't need to watch during the day. This is for the trader who works all day and comes home and updates his charts, downloads his charts and his daily charts or whatever, and scans through a group that he might happen to be interested in and see this. And after this little day right here, okay, let's go back where we were with March cotton. You see, we were right here with the 2 narrow range days. On this day, of course, the market rallies away. We have a decent close above the highs of the previous 2 days. And then the next day it gaps up. It has great ease of upward movement. This is certainly, if you deal with the true range from the previous day's close to this day's high, we have probably the best up day. It is an up day. It does close higher on the day. It's probably the best up day on the chart up to this point. And yet, it closes on the low, and it would certainly concern you that the market could get hit. But instead, there's no downward follow-through. And this is what I mean by the resurrection effect. That's what I've termed it. In other words, every time it looks vulnerable, it doesn't follow through. It's a sign in an uptrend that we're in an uptrend. Then the market tries to rally, it pulls back again. There's some attempt to turn the market down, and there's no follow-through. Right here, no follow-through, ease of upward movement. Increased volume says demand, although the volume is not very great. Much of the volume in November here is caused by the rollover out of the December contract and into March, for those of you who trade futures. So here the market has a very good ease of movement, but we know that when a market comes back to the top of a trading range, to expect difficulty. And right here, here's a strong day. We test the high, but the closing off the high and in the middle of the day says that the rally is tiring. You couldn't infer from that alone that it's bearish, but it would be a warning. In any event, the market tries to go up again and fails, and here it tries to hold, and I really thought after this day that we were poised to go. I have 2 cotton companies that I consult with. I was sending them this chart every day or every other day with these comments. And I thought after this day, which I remember correctly was a Wednesday, and I said, I think we're ready to go. As it turned out, we tried to rally and couldn't lift away and sagged down, and the next day it continues lower. What do you think happened on the next day? Any guess? It looks down, doesn't it? I thought so. Remember what I said yesterday? Anything can happen. Anything can happen. This darn thing opened about unchanged and just screamed up. I thought we were on our ready to go. We were ready to go up. But as it turned out, we went up above this high, and we've now worked down again, and you saw the chart today through Friday. I'm always drawing lines across levels of support and resistance, and you'll see that on some of these charts that we talk about. And I thought this was a level of resistance. It wasn't drawn too well. It wasn't drawn precisely off the high. But you see how we oscillated around this line. And then after we broke out above it, we came back and sat on top of it, which made me feel like, therefore, we are ready to go up. That was one of the things, plus the narrowing of the price range here. But as it turned out, it didn't perform the way I thought it would. And it did break down to here at least. All right, let's go to the next chart.
David, I could maybe just make a comment. I'm sitting looking into the pattern you showed. This is a very programmable
I was going to talk about it
search.
too, yes.
But then I say, well, how are you going to define it? Well, visually, I pick them up after having taken a class so many times. I pick the things that jump at me from the chart. But how do I program it? Obviously, you have to program that the previous important low has to be broken. Well, how far back will it look? Will it look back 2 months, 3 months, 5 months, 6 months? Question mark, right? Also, the second bar has to be shorter than the first bar. Is it supposed to be 1/4 of the first bar, 1/3 of the first bar? Don't know. Then there should be another bar, like all these things that visually just leap at you from the chart. But when you start thinking of programming them in some kind of strict manner, you realize that they're hard questions which you really cannot answer, or I cannot answer. If I say, well, the shorter bar with high volume should be about 1/3 of the previous bar's high. Well, what is not 1/3?
You can't make
1/2, right? Then I'm blocked. Yeah.
Or even if the volume here had been greater than here, that would have even been more bullish, because there would have been a tremendous effort to break the market, and yet all that volume didn't produce. It holds.
As I'm asking myself, how can I program? How can I have some smart friend program it? I say to myself, no amount of programming is going to be as good as just flipping through these charts.
Kerry and I have worked together and tried to develop a scan to identify markets, maybe not in this exact setup with the narrow range underneath the line of support, but just to run a scan that would identify those stocks at the end of the day that have gone under a level of support. So I could at least be attuned to which ones. Because as we all know, we don't see everything. We don't see the charts on all these markets. And some of the things that we did, we'll rule out certain parameters. Number one, we want to look, now this will be with stocks and not with futures, but a stock that's, say, under $95, above $5, has 50-day average volume of 200,000 shares a day. Just for beginners, to delete the dollar stocks that are in spring position that just aren't going to go anywhere, and that we didn't want to deal with the $200 stocks or the $150 stocks. And then maybe how many stocks have had a downturn in their 10-day moving average while their 20-day moving average is still pointed up. You see? I don't know what the averages would be on this chart. It would be something to work with. But we came up with rather large lists, which is too unwieldy. So we did some tweaking on it and came up with better parameters. But along those lines is a way to identify markets in a potential spring position. And much of what we're going to be talking about, or I'm going to be talking about and showing you, is the advantage that recognizing this situation, not just necessarily with narrow ranges. I'll show you some others that are equally powerful. My method here is trying to first, yesterday, give a little bit of insight into how to read, or at least how I read daily or any bar chart. How I look at the range and the position of the close and so on. I can't do that for 5 days or 4 days. So now I usually talk about trend lines and channels because that's an integral part of what I do. My best way of determining if a market is overbought or oversold, not my best way, my preferred way, is to look at where we are in a channel. And so we have here a chart of U.S. steel. And you see, of course, that we're in a trading range, which I've defined. I've drawn the resistance lines and the support lines, resistance line A and B, support line C, resistance D. You see instantly here at point number 1, what we've already discussed, a little spring. The market went underneath the line of support and did not follow through. When it went underneath the line of the support, there was no serious selling pressure. Now, I'm not saying that this would necessarily have been a spring that I would have been that attracted to, but that doesn't matter. It turned out that it worked. Where I would have become attracted to this spring, since we're looking at it, if you notice 3 days after the spring, the market had a fairly narrow range day, but it closed on the low. And that day was testing this spring. And you notice that the next day, it had no downward follow-through whatsoever and gapped up a little bit. And that would have suggested to me that the test of the spring was complete and that the market would indeed rally. The definition of an uptrend is higher highs and higher lows, right? We all know that. Now I'm looking at this section from day 1 to day 17. And forgetting the channel that I've drawn now, if you look at day 2, day 4, day 7, and day 10, and day 15, what do they all have in common? They all went down. The market went down on every one of those days. What happened on the next day? Was there any follow-through selling? None whatsoever. After day 2, the market gapped up. After day 4, the market gapped up. After day 10, it didn't gap up, but it turned right away up. After day 15, it gapped up. After each one of these days, we never traded underneath that day's low in the context of the trend from day 1 to day 17. So this is a trick. This is a way to get into a market. Forget about the spring. Maybe it never had a spring. If you had wanted to buy this double bottom, or whatever you call it, and you missed it, you could have gotten in after it failed to follow through on day 10. And when it immediately rallied away, put your stop there. It's just another way to enter a market that you might not have been able to catch. Now, why did the market stop at point 17? Look at the texture of the rally. It's having difficulty. It's not moving with any ease like it did at 10, or like it did at 2, even though it closed poorly at 2. So we're coming to the top of the channel. And now we get above the top of the channel at 17, and the market reverses down. Why is it that the market is failing here in addition, besides the channel? Previous resistance. Why? Because the people who bought the highs at A and B are thanking the Lord for the opportunity to get their money back. They're liquidating those longs. The people who were smart enough to go long here are now taking profits because this is a previous resistance level. And the smart shorts who see this possibility are going short. And the market is going to have to do what? Absorb all of this selling before it can go higher. And that may not happen in one day. It can be a process. After this absorption is completed, and you really don't know it's completed, you have an idea it is at point number 27, where you come after 26, there was a narrow range attempt to go down, and it closed back near the high. And at bar 27, it tries to go lower and reverses up and looks like it's ready to go. You don't know. If you want to wait for another day, you can. But then the market starts a new angle of advance, where I've connected the low of 27 and the low of 36 with a parallel across the high of 30. I'm constantly readjusting the channels. I know this is charting 101, but it pays to draw the channels. And from there, the market continues up, begins to struggle at the top of the channel, backs off, and then on the top day, when we hit $77.77, there's a pretty nasty downward reversal. In fact, that is the largest down day. That is a day where it closed lower. So the largest intraday sell-off of any day since we turned up from point number 1. I pay attention to those things. I look back across charts to see how does today's price range on this down day compare to any other day. If it's larger than X number of days, it catches my eye. I think it's more significant. If it's at the top of the channel, then that makes it even more interesting. But we also look at the bigger context. If you'll look at the next chart, we're also at 77.77 at the top of a channel drawn from on the monthly chart, going back to the 03 low, the 2003 low. You see? So this overbought condition on the daily chart becomes much more significant when we incorporate the weekly and the monthly chart. And that reversal action becomes more significant on the daily chart. Now I have this plotted through December 22nd when I prepared this presentation. And you see that in the month of December 2006, the market has rallied above the top of a resistance line and turned down, suggesting a possible upthrust, suggesting that if one is long U.S. steel, one might want not to be long anymore. You might not necessarily want to be short, but you certainly don't want to be long. I find that so many people who trade stocks, and this is sort of a digression, but so many people who trade stocks, number one, don't use stops. Because I own it, right? I can give it to my great-grandchildren. Well, they might be owning some very worthless paper. And in addition, they don't know how to take profits. They don't know how to get out of a market and decide, you know, I've made some good money on this trade. But right here, it certainly looks like U.S. steel, and I don't know what it's done since then. I don't remember it. I would imagine it's gone down. All right, now, I've developed or drawn this little diagram. It's called the dynamics of trading ranges. I really call it where to find trades. WTFT, where to find trades. As I said to you the other day, markets are mostly in trading ranges. Finding trades is like finding fish. I like to fish in freshwater lakes and ponds. And you get out in a little John boat, it's a little flat bottom boat, and you don't fish in the middle of the lake. You might run into something, you might snag something in the middle of the lake, but the fish are primarily around the edges of the lake. They're in the little hollows, they're on the drop-offs, they're on the points, they're around the sunken logs, and so on. So it turns out that around the edges of the trading range is where I look for trades. I mean, we've already been looking at springs, where a market goes underneath the trading range and reverses upward. But sometimes the market does not turn up. Instead, it breaks down. I wrote the word or. Sometimes the spring action fails and it reverses and goes down. It's not uncommon for the market to, at some point, rally back and test that breakdown before it goes lower. Conversely, when markets come up to the top of a trading range and fails to break out, we get what's known as an upthrust. So I can find upthrusts and I can find springs. In addition, when a market comes up to the top of a trading range and doesn't reverse down and stays there and churns, that's that absorption that I spoke of. And then we go higher, and sometime we may back up and test that breakout before we continue higher. You can make a living trading nothing but springs and upthrusts. Finding those two positions. When markets fail to follow through, now I don't mean to just carte blanche shut your eyes and go short. We don't want to stand in front of freight trains and just go short because it just made a new high and stumbled. Nor do we want to necessarily go long just because it's hesitating. We want to evaluate the situation. We want to look at the individual daily price bars and the volume. You see? But just these two little tricks, if you do it for a year and say, I'm only going to trade springs and upthrusts, and if you don't want to go short, just do springs. Just hope it's still a bull market. Because springs don't work very well in a bear market. In a bear market or in a downtrend, springs often fail. In an uptrend, upthrusts usually fail. I have tire marks all over my back from going short upthrusts, potential upthrusts in the S&P, thinking, aha, this is an upthrust because it failed to follow through, and it hesitates, and then it goes on up again. In an uptrend, those upthrusts, they don't work too well. Because why? The underlying trend is always the most important piece of information. All right, we'll stop and then come back in just a few minutes. We'll start back. Now I've shown you this little diagram about where to find trades. This model is in my head all the time. I'm looking at charts and trying to determine when there's a trading range, what position might we be in? Going back to our chart of U.S. steel on the daily, in terms of where to find trades. Here the market shortened its upward thrust. In other words, it went a little higher, and you could also call that an upthrust. The distinction between shortening the thrust and an upthrust is very fine. But anyway, this was a little absorption area around this line of resistance. And then here, when we got up to point 17 on the daily chart, as I said, the market was pumping up and down. What are the clues that this is absorption and not a top? Because every time the market goes above a level of resistance, we're faced with two possibilities. One, it's an upthrust, or two, it's going to be absorption and the market is going to go higher. And at times, it's going to look like an upthrust. Certainly on this day here, number 17, it looked like we had upthrusted these highs and turned down. And the next day, day 18, added weight to that argument that this market could be indeed reversing down, having failed to break out. Another whipsaw. One of those lovely things that happens over and over again in the market. But instead of following through, the market bobs back up and shows a buoyancy. You see, it actually even pops up to a new high. And then it comes back down, but it's still making higher supports. You see? And how much of a percentage of this upwave from bar 1 to bar 17 have we retraced? If we're not retracing a great deal, and if we're remaining buoyant, these are good signs that this is indeed absorption. But absorption is a difficult thing to recognize or to be certain about. But reading this situation is not easy because there's conflicting evidence day after day. If you're an investor, you may just focus on the weekly chart. But if you're a swing trader, it becomes more important. All right, let's look at the next chart over here, LVLT, level 3. I used to write on this chart when I showed it before. I just put the lines and the dates, and I had written above it, in the beginning, an unmarked chart. But here, the chart is marked for you. Here's a trading range. You see the spring? See how the market went underneath the level of support? It doesn't go straight up. Many times springs are tested and then zoom. For somebody who likes to trade 10,000 shares of stock or 20,000 shares of stock, buying springs can be great, fast reward. It's very typical to see a spring have this tremendous liftoff. And we're going to look at hardly anything but springs as we talk over the next few days. You see the market rallies up to a high here on September the 25th. It closes well off the high. The market has a reaction. So from that high, I draw a line of resistance. From the reaction low, I draw a line of support. I tailor my lines of support and resistance to show that the market failed to follow through on these breakdowns and failed to follow through on this breakout here. As this trading range evolved, another level of resistance formed. You see? But all of these situations, when it broke underneath these lows, there was no follow-through. Look at all of the little inside days after this spring here on November the 17th. I pay a lot of attention to inside days. It's not my work, it's the work of Toby Crable. I think it does have value. He wrote articles about open range breakout in Stocks and Commodities magazine. It's now technical analysis of stocks and commodities. And those articles are readily available. It's an interesting theory, talking about different types of narrow range days. But more importantly here is just the fact that the market is so compressed. And that's what happens with a spring, is you have this compression. And then it's just spring, it just releases. And you have a very fast run. Even this could be construed as a spring. I think it's a little bit too deep a break, and we'll discuss that in a moment. But anyway, right over here, fifth day from the end, there's a very high volume, 20 million plus share day. And the market tries to rally on that day. It doesn't close all that well. Closes sort of in the middle. That would be a day that you would think would hurt the stock, that there was massive selling. And just thinking about it logically, there's no more downward movement. Instead, the market keeps pressing its way upward, as it does in the last 4 days. Just pressing. What does that mean? It's like the people who are trying to batter down the castle door to get the Lady Marian. So this is absorption. Another example. All right, let's go to the next chart. This is a caterpillar. This is what my charts look like. I'm drawing all of these support and resistance lines. All of these boxes. RS, TU, AB, EF. I'm watching markets in boxes. You know, we're all told that price movement unfolds in waves. I believe that. But it also unfolds, in my opinion, in boxes, or really rectangles. In other words, there's lots and lots of trading ranges. And I'm going to draw lines around every one of those trading ranges to see if I can ferret out a little spring or a little upthrust. Then I might be able to trade. Now this is not for the investor. This is for the swing trader, the short-term trader. You see the market rallies up to point R. It has a great deal of volume. The volume is clipped here so that we can see the rest of it, because it would have dwarfed all of this volume. And it gaps lower. I guess that heavy volume is on this day. In any event, this is the high point. This is where it finds support, and it rallies. So I draw lines R and S. We go into a trading range. We rally up to point T. We come back down and find another level of support right here at point U. So that we've got a trading range within a trading range. And notice that we don't come back and spring trading range RS, but we do spring trading range TU. the spring of line U right here. And we have a little apex right here. An apex representing a point of equilibrium between sellers and buyers. And so we tried to break out of that apex to the downside, and we had that little spring and we bobbed right back up. So now we come to the top of line T, trading range ST, trading range TU. And there it is, that pumping up and down, but not giving significant ground, called absorption. And then the market goes again, and here's my channel, drawn from this low to this point of this spring across the high at R, and up here, OB, overbought. I don't use the RSI, I don't use the stochastics to tell me that we're overbought. I'm just saying, look where we are in the channel. I don't want to be a player anymore. If I had bought this market, or if I missed it and wanted to buy this market, up here at point at the top of this channel, I stay away. So the market moves lateral, has a little tiny upthrust right here at A, and turns down. We form a new trading range. Line A and line B. Resistance, support. So what happens in this trading range? The market oscillates around, and right here, it goes above the top of that trading range, the proverbial upthrust. Look at the character of the behavior on that upthrust. It goes higher and reverses down underneath the lows of the previous 3 days and closes near the low. E is a downward movement. S/D, supply overcoming demand. Again, the market breaks again. It didn't stop and tried to spring trading range A, B. It just kept going. The ball is thrown into the sky, and it finally is hit by gravity and it falls. Where does it find support? Where does it first bottom? The first bottom is right here. So I draw a line of support. This is all short-term reading of a chart. Now it's true that there are more significant levels of support on charts. But in just dealing with this situation, I would definitely draw a line under that support. The market rallied all the way back, broke down. It finds support here at line C. Now, here was a failed spring. Here the market came down and went into, could have reversed, but instead it fell apart. Now it's come back to test that breakdown. As I showed you on that where to find trades, testing the breakdowns, when it doesn't spring and it continues lower, often a market will come back and test that level from which it fell. Another place to get short if you're an aggressive, active trader. Then I drew a support line here. I made a mistake here and called this a spring of C. It is pulling back to test the apex of this, but I think this is a little bit too deep. It's just the completion of the correction. But from that point we turn up. Here, it's absorbing right along this level. I'm always looking for lines on charts that I call axis lines, where prices have revolved back and forth. For example, line B. Line B was support here. It was resistance here on the test of the breakdown. Here it was absorbed. After the rally to E, it tried to hold there temporarily. It went under it, but it didn't close under it at point F. Went higher, broke down, tried to rally up to it again. I'm always watching the interaction around those lines. Sometimes it guides me towards some trades. Up here we had this trading range EF. The market upthrusted that. There was a lot of volume. I wrote E/R, effort and result. So a lot of effort, no result, downward reversal. Now here's a perfect example of a spring that doesn't work. The market comes down to line F, and it flails up and down. You see I wrote the word failed spring. It's trying to spring. In downtrends, springs don't work too well. You still have to evaluate what's going on in there. And when you see the market on the next to last day in here coming back to the low, it better rally from that point. But it doesn't mount any kind of a rally at all, so we plunge again. And here, There's a lot of effort on this big day, and yet the reward in terms of breaking under support line D is not very great, and on it goes. But I'm drawing these little boxes. It's like a viewfinder. You know how great photographers of the 20th century and the 19th century would hold up a little box and frame whatever they wanted to shoot, sort of like this, compose a picture? Well, I'm composing the price movement. This is my viewfinder, these little boxes. I'll show you this on a 5-minute chart. I wear about 3 different hats in terms of trading. I do look for very long-term trading situations, what I call position trades in the futures markets. And I look for swing trades, and then I'm day trading. The man who taught me, a man who was making all of the money I told you about yesterday, this was in the early 70s, 71, 2, 3, 4. He traded futures for long-term capital gains, which you could do in those days. So he held contracts for 6 months. If he were interested in cocoa right now, he'd be buying March 08. And he traveled the world. I would call him in Machu Picchu and tell him what the market was doing. He'd say thank you. All right, let's go to the next chart. This is Cypress Semiconductor, CY. Again, the same things. Drawing these trading ranges, drawing trend lines, drawing channels, labeling the ranges. Sometimes I label the trend lines. Look at this axis line here. Look at this line KK. Look how it was resistance here. Of course, that's where I drew it. We came back to it here, resistance. Here we upthrusted it seemed, but it turned out that all of this was absorption. Then we rallied off again. We tried to back up to this breakout and hold, but we failed. We broke through it. Constantly watching that kind of action. Look right here at this line. It was support here tentatively. It washed it out and rallied, broke underneath it, rallied up to it, failed, rallied again, essentially came back into that same area over here. Another kind of trend line that I draw, and I didn't develop it, is a reverse trend line. Normally in an uptrend, you draw a trend line from one low to another low, right? But you can also draw an uptrend line off of highs, successive highs. This is a reverse trend line. So I took this point and this point, connected it and drew the line. And of course, I always like to see this rising wedge kind of behavior because it means to me, it's not because of the geometric shape, it just tells me that the market is making less and less upward progress. Look, we have a high here at 1705 and we break. We rally all the way to 1879 and we break. And where do we go on the next rally? 1880. We make a penny. For all of that, that is shortening of the thrust. That is very well depicted by this rising wedge. Right here, this little break of line D. This is a kind of a spring situation that I particularly like. The market breaks under line D and closes well under it, has pretty good price spread. Sometimes it closes right on the low. Those sellers seemingly have the advantage. If the market gaps up the next day, and the more it gaps, the better it is, buy it. It'll work a great many times, and most people are very hesitant to say, they'll say, I'm not going to buy that. I think I'll wait and see if it'll pull back. Many times you'll have a spring where it closes underneath the level of support, and the next day there's no follow through and it bobs right back up above the high of the day it broke down, or right back to the high. That's a setup that I like a great deal. I'm just judging the market's behavior. When I see it run into trouble, I pull the ripcord, and I'm out of here. I'm mostly interested in not how much I'm going to make, but how much I don't want to lose. So if I work with that premise that I can at least make trades where my loss is defined and small, then I'll let the profits worry about themselves. It's variable. Sometimes the spring will work and sometimes it won't. And the other variable is you don't know how much you're going to make. Any question? All right, let's go to the next chart. This is the S&P. Here's a downtrend, down channel. I could not draw that down channel until after this high was made. You understand? This channel is begun with a line off this high and this high. So once that high was made and the market turned down, then I could draw this line and this parallel line. I see here on June the 8th, this is the June 06 low and the test in July. This is a very important low because from there we've gone up incessantly. On June the 8th, look how much volume came out. Tremendous amount of volume. The market took out that level of support and it looked like we were having a spring. Now there's one caveat about this volume. It's rollover time. In other words, there are people who are getting out of the June contracts. They've already started. They're almost out and rolling into September. But the market, this spring failed. It tried to go the next day and it couldn't go, and then it came right back down and closed right on the low. But on June the 13th, wide price spread, closed near the low, and very heavy volume, and we're near the bottom of the down channel. I can't say that I bought that. The market rallied away rather quickly here on June the 15th, consolidated, went higher, and another trading range started between July the 3rd and this low here, July the 18th. But look at this pullback. If you were looking at this on an hourly chart, all sessions, where you have what, 23 hours per day, and you've got 3 days, so you've got 69 hours, or let's say 50 hours of price movement here for these 3 days, and the market goes underneath this level of support created by the previous 2 days, I might be interested in that, and I would be. It doesn't look like a spring here, but on an hourly chart, all sessions, or a 30-minute chart, all sessions, I would see that the market dipped underneath the low and didn't follow through, and then we have follow through and so on. Here's absorption, right here. Market's pumping and pumping and pumping, and then we break out right here, and now we're pulling back and testing the breakout and holding on top of this previous resistance line. And from this point, which was like September the 11th or 12th, it really went up quite nicely. I keep altering the angle and adjusting the angles of advance or decline as the market unfolds. And as I said to someone a moment ago, when I'm watching the S&P, for example, during the day, and if it's right over here in this part of the chart at this time, I might have a daily bar chart that just shows this much. And that would be one piece of my screen. And then I'd have an all sessions hourly chart. It covers a large portion of my screen. And then maybe a 5-minute day session chart underneath it. So I'm watching, and I've got lines drawn on all of those, watching the levels of support and resistance. Well, I think this is a good spot to stop for the day. If you have any questions before we go to dinner, well, we'll call it a night.
Yes, thank you very much, David.
My pleasure.